right, guys, let's start. Okay, now we are doing lesson number 4, which is about importance of yield curves in pricing and risk management. We are still continuing with chapter number 1, which is introduction to yield curve, right? So let's get started, guys. Let's dig deeper. In lesson number 1, we saw the term structure of interest rate. Lesson number 2, we saw the zero coupon, yield, spot rate, etc. Lesson number 3, we looked at your yield curve shapes, right? Now we are looking at in pricing and risk management. Okay, so let's dig deeper, guys. Let's try to understand more. Now, when you look at your yield curve for discounting, right? Basically, discount factors derived from the yield curve. Any financial asset that generates future cash flows must be valued using discounting. The discount factor of maturity T is obtained from a zero coupon spot rate. If the contract is commanded zero rate from maturity T is RT, the discount factor is given by this equation, where RT is contract commanded zero coupon rate from a maturity T. PT is present value of 1 received at time T. A yield curve provides zero rate for all maturities. From these rates, we obtain the entire set of discount factor used for valuation. These discount factors essentially in pricing, governments and corporate bonds, interest rate swaps, FRAs, other fixed income and derivative securities, right? So basically in this slide, what is happening, right? Two forces are named as drivers of curve shape, expectation of future short-term rates and your risk premiums. Term defined here are your yield curve, a plot of interest rate against maturity for one issuer and one instrument type at one point in time. Maturity is the time remaining until the loan is prepaid. Pure expectations hypothesis is a theory that long rates are built only from expected short rates. There is liquidity premium also, which means that extra yield demanded for holding a longer bond. The formula which you need to understand, right, is something like this, right? 1 plus Rn raised to power n is equal to 1 plus R1 plus R2 1 plus Rn, right? 1 plus capital R sub n all raised to the power n equals 1 plus R sub times 1 plus R sub 2 and also 1 sub up to 1 plus R sub n, right? So it says that investing runs for n periods, right? Must pay the same as rolling one period deposit n times in a row, right? R sub n is the annual spot rate, which you need to keep in mind for a loan of n period. N is the number of periods. R1 is the period rate today. R2 through Rn are the one period rates apply in each period. Both sides are growth factors. So the left side compounds one rate n times, the right side is n different rates. Okay. What you need to understand here is very clearly there are two theories here, right? Which needs to be kept in mind, right? One is the pure expectation hypothesis, one is the liquidity preference hypothesis. Pure expectation means long rate is equal to average of expected short rates, which you've seen earlier also. Forward rate is equal to expected future spot rate, term premium is 0. Liquidity preference theory is basically long rate is equal to average of expected short rates plus a premium. Forward rate is equal to expected future spot rate plus a premium, right? So that's what we need to understand very, very clearly. Okay. Also, another point here is, right, which you need to be very, very clear is that when you talk about your yield curve, right? Yield curve is basically a line that gives the interest rate for each security at one point in time, right? And terms of the interest rate is the same object under a different name, right? The two phases are kind of used interchangeably in this presentation, right? And the whole presentation, if you look at it, right, has 3 blocks, right? First, we talk about pricing, which is slide 2 to 7, then we talk about risk management, slide 8 to 12, and then we talk about market uses, slide 13 to 17. And slide 18 to 22 are your practice problems, right? And in the this presentation, right, this first slide, right, the slide basically states the job of the yield curve, turn a future cash flow into a value today. Okay, discounting is basically reducing a future amount to its value today because money received later is worth less than money received now. Zero coupon rate, zero rate, spot rate, the single interest rate that applies to one cash flow paid at one fixed date with nothing paid before that date. And continuous coupon rate basically means interest is added at every instant rather than once a year or twice a year, right? This convention makes the discount factor an exponential, right? And that is what is given here, right? The formula says the value today of 1 unit of currency paid at time t falls exponentially as the rate and the horizon rises. RT is nothing but the continuous compounded zero rate for maturity T. T is the time to that payment in year. PT is the discount factor, which is the present value of $1 paid at time T, and it is built because every valuation below is built from these numbers. So we read it as your P of T equals exponential raised to the power minus R of T times T, right? Note that note the structure, right? The yield curve supplies RT for every maturity. Applying the formula at each maturity converts the whole rate curve into a whole set of discount factors. Slide lists what these factor price, government and corporate bond, interest rate swap, forward rate agreement, other fixed income and derivative securities. One clarification I'll add here is that the formula is written basically price the default free cash flow. A corporate bond cash flow is not default free. For a corporate bond, the discount factor is your plus there is a spread which we have to add. This spread we have to add where SD is the credit spread for that issuer and maturity rate as P of T equals exponential raised to the power of minus the quantity R of T plus S of T times T. The object on this slide are easy to confuse. We have zero rate, a rate quoted per year, usually rises with maturity. Discount factor is basically price quoted per unit of currency. Discount factor is always false maturity when rates are positive. The one difference that matters is the rate is an annualized percentage. The discount factor is number between 0 and 1 that multiplies the cash flow where it is used. Every pricing model in this day starts by pulling PT of the curve. Then we get into next slide, which is pricing your coupon bearing bonds, right? Bond price using your spot yield curves. Coupon bearing bond generates multiple future cash flows. Each payment must be discounted using the appropriate discount factor from the yield curve. If the bond has coupon cash flow CI at times TI, the bond price is given by this, where CI is coupon payment TI, TI is discount factor obtained from the spot yield curve. The inside is each bond cash flow occurs at a different maturity, therefore each payment must be discounted using the corresponding spot rate from the yield curve. Without a yield curve, bond valuation becomes inaccurate because a single interest rate cannot directly discount all future payments, right? So the slide basically applies slide number 2 to a bond that pays several times. That is what is given. P equals the sum from I equals 1 to n of C sub I times P of T sub I. The formula says the bond price is sum of every future cash flow each multiplied to the discount factor for its own payment. Date CI is the cash flow paid at time TI. TI is the date of the ith payment in years and is the number of payment. PTI is the discount factor rate of the spot curve at that date. It is used because the payments arrive at different times and each time has its own rate. The slide student point is one flat interest rate cannot correctly discount payment at time on different dates. The curve can. One clarification I'll add here, the slide defines CI as a coupon payment, the final cash flow CN, the last coupon plus the face value of the bond. The face value is dropped, the formula applies only the coupon straight and understates the bond. Two prices are easy to confuse here. Price from the spot curve, each cash flow uses the own rate, RTI. Price from the yield to maturity, every cash flow uses the same rate by. Price from the spot curve, no arbitrage, just fit market. Price from the yield to maturity, a single summary number quoted for comparison. The one difference that matters is the spot curve price is the correct valuation, the yield to maturity is the one rate that reproduces that price. Where it is used, this is the pricing engine behind bond market portfolio valuation, the duration number on slide number 8. Then we go into next part, which is slide number 4. Yield curves and forward pricing, forward rates and forward pricing. The forward rates extracted from the yield curve determine the pricing of several derivative instruments such as futures, forward rate agreements, and forward bond contracts. The forward rate between T1 and T2 can be written as this equation which you already seen. Application of forward rates, lock-in borrowing on any other future date, construct interest rate hedging strategies, price forward starting swaps and structural products with value callable bond and other interest rate securities. And forward curves therefore represent the market expectation of future short-term interest rates. Okay. So this slide moves from rates for today to rates for a future period. Forward rate is the interest rate agreed today for borrowing or lending over a period that starts at a future date. Forward rate agreement is a contract that fixes an interest rate today for a single future period. The formula is given, which you've seen earlier also. This is continuous compounding formula f of t1, t2 equals the quantity r of t2 times t2 minus r of t1 times t1 all divided by t2 minus t1. The formula says the forward rate is extra interest earned between t1 and t2 spread over the length of that gap. T1 is the start of the forward period, t2 is the end. RT1 and RT2 are the continuous compounded zero rates to those dates. F T1 and T2 is the forward rate for the period between them. It is used because it removes arbitrage. Lending to T2 directly must pay the same and lending to T1 and the rolling at the forward rate. The slide basically lists four uses: blocking a future borrowing or lending rate, building interest rate hedges, pricing your forward starting swaps and structured products, and valuing callable bonds. One clarification I'll add here is the closing line says forward curve sits within the market expectation of your future short-term rate that holds only under the pure expectation hypothesis. Observed forward rate also contains a term premium and prolonged maturity, the convexity effect. The forward rate is a break-even rate, not a forecast. Please understand that forward rate basically means fixed today by no arbitrage from the curve, tradable and hedgeable. Expected future spot rate is basically an opinion about where rates will go, not directly tradable. Okay. One difference that matter here is the forward rate is the level at which a position breaks even, and the difference between it and the expected spot rate is the term premium where it is used. Forward rates at the floating leg of swaps on slide 5. And they set the strike versus forward comparison in caps and swaps on slide number 6. So here yield curve and swap pricing, OIS discounting, and multi-curve framework. More interested swap prices use the multi-curve framework. Two curves are typically used: OIS curve used for determining cash flow, IBOR, SOFR, SOFR used to protect your floating rate. The fixed swap rate satisfies this equation where PTI is the discount factor from the OIS curve, alpha is the accrual period. Accurate swap valuation requires a precisely bootstrapped yield curve structure. Okay. So basically, the slide states that modern swap prices using two curves, not one. Interest rate swap is basically contract to exchange a fixed interest rate payment for a floating interest payment or a notional amount on set dates. OIS is basically overnight index swap. Its curve is built from overnight rates and is treated as close to risk-free. They used for discounting. IBOR or SOFR, right? Interbank offer rate and secured overnight financing rate that replaces most IBOR benchmark. This curve is used to project the floating payments. Multi-curve framework, the practice of discounting on one curve and projecting floating rates on another. Then we are bootstrapping, building a zero curve step by step from floating market instrument, shortest maturity first, which is given by the formula, which is S equals 1 minus P of T sub n, all divided by sum from I equals 1 to n of alpha sub I times P of T sub I. The formula gives the fixed swap rate is the value of the floating rate divided by the value of 1 basis point of fixed payment. S is the fixed rate that makes the swap worth zero at start. PTI is the discount factor of payment date. TI, alpha is the actual period, which is the year fraction between payment day I minus 1 payment date I under the relevant take count rule. TN is basically the final payment date. The denominator is called the annuity or P01 for scaling. They use because the path swap has zero value at inception, so the fixed rate must exactly match the floating leg. One clarification I'll add here is the numerator 1 minus PTN is a single curve result. It comes from discounting projected floating payments with the same curve that generated them, which makes the sum telescope, right? That contradicts the multi-curve setup, which we look at, right? Because the slide says multi-curve setup. The multi-curve setup, if we have to use, right, it has to come as the numerator should be this for multi-curve setup. Okay, S equals sum from I equals 1 to n of alpha sub I times F sub I times P of T sub I, all divided by the sum from I equals 1 to n of alpha sub I times P of T sub I. Here Fi is the forward rate of period I taken from the projection curve, and PTI comes from the OIS curve. The two formula agree only when the projection curve and the discount curve are same. Discount curve means OIS tied to the collateral funding, answers what a future payment is worth. Projection curve is software term or IBOR tied to the floating index, answer what the future payment will be. The one difference that matters is one curve sets the size of the cash flow, the other sets its present value. Where it is used, this is the core of swap desk valuation. The denominator is the annuity used to convert the swaption price into rate terms. Okay. Then we go to next part. Yield curves in your interest rate option pricing, role of your term structure in interest rate derivative. Interest rate derivatives such as caps, your floors, and swap can rely heavily on the yield curve for valuation. Key inputs, forward rate curve, expected future interest rate, discount curve, present value of cash flow, volatility surface, uncertainty in future rates. Under the risk neutral framework, the derivative value becomes this. Therefore, the entire term structure of interest rate forms the foundation of modern interest rate derivative pricing, right? Side basically covers options to pay off events on interest rate. Cap is a contract that pays when a floating rate rises above set level. Floor is a contract that pays when the rate falls below a set level. Swap option is basically an option to enter the swap at a set fixed rate. Volatility surface, a table of implied volatility across strikes and maturity. It measures how uncertain the market is about future rates. Risk neutral measure Q, a change of probabilities under which any asset's price equals the discounted expected value of its payoff. It is a pricing device, not a forecast of real world odds. Slide basically lists three inputs: the forward rate curve for expected future rates, the sound curve for present rate, and the volatility surface for uncertainty. We equal the expectation under the measure Q of exponential to the power minus RT times the payoff. The formula says the option value is the average payoff across your all future dates discounted back to today with the averaging done under Q. V is the value under V is the value today. E superscript Q is the expectation under the risk neutral measure. Exponential minus RT is the discount factor. Payoff is the cash that the contract delivers at maturity. It is used because it is a general pricing rule for any derivative. One clarification I'll add here is the formula is written pulls exponential minus RT out as a constant that is not valid for interest rate derivative where R is itself random. The correct statement in that case would be payoff. Okay, V equals the expectation under Q of exponential bar minus the integral from 0 to T of S of R sub S ds times the payoff and the equal and that equals P of 0 comma T times expectation under the T forward measure of the payoff R as the short period of time S P0 T is the today's discount factor of 2T ET is the expectation under the two forward measure in which the discount factor moves outside the expectation cleanly. The second form is via cap and swaption formula that put it on pound rate. Spirit is used, Monte Carlo pricing of interest rate option. Simulate path of RS, compute the payoff in each part, discount rate and average. That average is the expectation in the formula above. Then we get into next part, which is your graphical role of yield curves in your derivative pricing. Look at the forward curve and discount curve in pricing. We have rate and maturity. We have forward curve, discount curve. The slide shows one chart. The horizontal axis maturity in years from 0 to about 10. The vertical axis labeled rate from about 2 to 4. The blue line labeled forward curve rises from about 2 to about 3.5. The red line labeled discount curve falls from 3 to about 1.8. The ones in the picture shows is the forward curve and discount curve moves in opposite direction across maturity. The caption states the split of labor. Basically, the forward curve sets what forward for the future rates are expected to be. The discount curve sets what this future cash flows are worth today. In clarification, I'll add here the chart is schematic and the vertical axis is mislabeled for the red line. And discount factor is a unitless number and that starts at 1 and falls toward 0, so it cannot sit on a rate axis between 2 and 4. The red line were a discounted curve. It would rise with the forward curve, not fall. The correct presentation uses two vertical axis rates in percent on the left and the forward curve discount factor from 1 down to 0 on the right for PT. Okay, so forward curve determines future rate expectation and while the discount curve determines the present value derivative cash flow. Then we get into next one, which is yield curves and risk management, duration and convexity. Yield curves are essential tools for measuring interest rate sensitivity in fixed income portfolios. Modified duration is given by this formula. Convexity adjustment is given by this formula. Risk managers evaluate several types of yield curve changes. Parallel shift of the curve, steepening and flattening movements, plot versus risk. A complete yield curve is required because each maturity reacts differently to interest rate changes. So, slide basically moves from your valuation to sensitivity. We have Macaulay duration, which is DMAC given here, right? The weighted average time to receive a bond cash flow in year with weights equal to each cash flow share of present value. Modified duration, the percentage price change for a 1 unit change in yield, D modified is equal to DMAC divided by 1 plus Y. The formula converts a time measure into a price sensitivity measure. Y is the yield to maturity, yield as a decimal, the division adjusts for compounding. It is used because trader needs a price response, not an average waiting time. Then we have delta P over P is approximately equal to minus D modified times delta Y. The formula says the percentage price change is minus duration times the E change. Delta P is the change in price, P is the current price, delta Y is the change in yield as a decimal. The minus sign accord that prices falls and yield rise, it is used as a first order estimate of interest rate risk. Then we have convexity. Convexity basically the curvature of the price yield relationship is correct the straight line estimate above. This is given by this formula, which is what? Delta P over P is approximately equal to minus D mod times delta Y plus 1 half times C times delta Y squared. The formula had a second order term because your delta Y square is always positive. Positive mixity helps in both directions. It reduces loss when yield rise and adds to the gain when yield falls. They use because the duration estimate degrade once yield moves gets large. The size and list three curve movements. Risk manager examine parallel shift, deepening and flattening in risk. In clarification, I'll add here duration convexity is written measure only a parallel shift. So both use a single uh, delta Y. They cannot measure steepening, flattening, or twist. Those need heated duration or partial division one, which reports sensitivity to each maturity bucket separately. So we look at modified duration, which is the first derivative of price with respect to yield scaled by price. It's linear, symmetric in both directions. Then we have your convexity, which is second derivative scaled by price curve, symmetric in effect. The one difference that matters is duration unknown predicts equal gain and loss for equal up and down move. Convexity but breaks that symmetry. Where it is used, duration sets hedge ratio for futures and swap overlays and drives the portfolio loss estimate in your practice problem number 3. Then we get into slide number 9, which is about economic value of equity, asset liability management, and yield curve. Bank use the yield curve to evaluate the sensitivity of their balance sheet to interest rate movements. Economic value of equity is EV is equal to present value of asset minus present value of liability. Changes in the yield curve affect your market value of assets, loan and bonds. Market value of liabilities, deposit and funding, economic value of equity. Example, a parallel plus 1% interest rate shock often reduces the market value of long duration bond assets more than deposit liabilities, and the result in a decline in the bank's economic value of equity. Right? Slide basically applies present value thinking to a bank's whole balance sheet as liability management. When we look at management of a mismatch between what a bank's own and what it owes. So economic value of equity, present value of assets minus present value of liability. The formula says the bank's economic equity is the market value of everything it owns minus the market value of everything it owes. Present value of assets, discount loan bonds cash flow of the curve. Present value of liabilities, discount deposit and funding cash flows of the curve. It is used because equity ignores rate moves while EVE, economic value of equity, captures them. The slide basically notes that a curve change moves the value of assets and the value of liabilities and the difference between them. The slide example, a parallel 1% rise in rates usually cuts the value of the long duration bond asset by more than it cuts the value of deposit liabilities. So EVE, economic value of equity, kind of falls. So the clarification I'll add here is 2 points sharpen the example. First, that results hold when the bank runs a positive duration gap, meaning asset duration exceeds liability duration. The bank with the opposite gap gains. Second, deposits without a fixed maturity have no contractual cash flow schedule. So the duration comes from a behavioral model of how long balance stays and how fast their rate follows the market. That model choice drives most of the reported EVE sensitivity. Economic value of equity, a present value for all future cash flows, long horizon market view, net interest income, all earnings flow over the next 1 to 3 years, short horizon accrual view. The one difference in matter, economic value of equity captures the full life of the balance sheet, net interest income captures only the near term. Where it is used, economic value of equity sensitivity is a reported regulatory metric and drives the size of bank interest rate hedge book. And then we go into the next one, which is nothing but value of at risk for fixed income, yield curve factors in your war models. Interest rate value at risk model simulate possible movements of the yield curve to estimate your portfolio losses. Common approaches include historical simulation, parametric variance covariance, war, Monte Carlo estimation. Primary yield curve risk factors are level shift, which are parallel changes, slope changes, steepening or flattening, curvature changes, some movements. These yield curve factors determine the interest rate war for bond portfolios, interest rates for mortgage flexibility. So slide basically covers how curve moves be the loss estimate, right? So value at risk, we understand, right? The loss that is not exceeded for a set over a set holding period at a set confidence level. The slide lists three approaches. Historical simulation basically apply your past observed curve, move to today's portfolio and read of the loss distribution. Then we have parametric war, variance covariance. Assume rate changes, follow a normal distribution and compute the loss from the covariance metric and the portfolio sensitivity. Then we have Monte Carlo simulation, generate many random curve paths from a chosen model, revalue the portfolio in each and read of the loss distribution. The slide then names three primary curve risk factor, level shifts, slope changes, and curvature changes. And these are the standard first three principal components of curve movement. Mortgage-backed security is a bond backed by a pool of mortgages where borrowers may repay early. On technical clarification, parametric wall use the duration to map rate moves into price moves. That mapping is linear and falls on the last item on the slide's own list. MBS has negative convexity because prepayment price when rates fall and cut off the price again. Portfolio containing MBS caps, floor, swap can need full revaluation in the historical simulation on Monte Carlo. When you look at the level slope curvature risk factor, please understand extracted statistically from past rate changes used to simulate your future moves. Level slope curvature as Nelson-Siegel factor will come in your slide number 13. Those are imposed by a chosen functional form and fitting one term used to describe the curve today. Right? The one difference that matters here is one set describes how the curve moves, the other describes how the curve is shaped. Where to use the Monte Carlo path and value loop. Here is the same machinery as the option planning loop on slide 6, run with the real world measure instead of Q. Then we go to slide number 11, which is stress testing and scenario analysis, regulatory yield curve stress scenarios. Financial institution must perform stress testing on interest rate exposure. That's simple. Regulatory framework such as Basel III and IRRBB require banks to evaluate extreme yield curve movements. Typical stress scenarios include parallel upward and downward shocks, steepening and flattening curve shapes, low rate environment scenarios, high inflation interest rate spike. Each stress scenario corresponds to a different shape of the yield curve and help institutions assess resilience during your adverse economic condition. Very simple. The slide basically covers deliberate scenarios other than statistical one. Basel III, basically the International Bank Capital Risk Standard. IRRBB is the interest rate risk in the banking book, the rule set that governs how banks measure your rate risk on non-trading position. The slide basically lists four scenarios types: parallel up and down shocks, steepening and flattening shapes, low rate environment, and high inflation rate spike. Each corresponds to different curve shape and each tests whether the institution survives it. Clarification I'll add here is the IRRBB standard prescribes 6 scenarios, not 4. They are parallel up, parallel down, steepener, flattener, short rate up, short rate down. The steepener, flattener are defined as combination of short end and long end move to set weights, and shock sizes vary by frequency. We have value at risk, probability weights calibrated to observe history, reports a loss at a stated confidence level. Stress testing, scenario based, chosen to be severe and plausible, reports a loss under one named state of the world. The one difference that matters is BOR attaches the likelihood to the loss, the stress test does not. Where to use stress test result, stress test field, capital planning, head sizing, and the limit set on the curve position described on slide number 14 and 15. Then we get into graphical view of yield curve risk factor, parallel slope and curvature shocks. We have yield and maturity graph, risk management model evaluate how these yield curve movements affect your portfolio values and financial stability. The slide basically shows one chart with 4 lines. The horizontal axis is maturity in years running from 0 to about 10. Vertical axis is yield in percent running from 2 to 5. The blue line original curve starts at 2 and rises steadily to about 3.7. The red line parallel shaped has the same slope but starts at 3, 1 full point above the blue line at every maturity. The green line steepening starts at the same point as the blue line and rises faster, reaching about 4.4. The purple line curvature changes, starts at 2, bulges up to about 2.7 near the 5-year point, then settles back to 2. The one thing the picture shows 3 different ways a curve can move drawn against the same starting curve. To read the 3 shocks of the geometry, a parallel shift moves every maturity with the same amount. The gap between the red and blue line is constant. A steepening pivots the curve. The short end is kind of unchanged. The long end rises. The green line meets the blue line at 0 and separates from it as maturity grows. The curvature change moves the middle of the curve related to both ends. The purple line lifts the belly and leaves the 2 ends near the original level. The caption basically states the risk models evaluate how these movements affect your portfolio values. One clarification I'll add here is the chart shows only one direction of each move. Each shock has a mirror image. A parallel shift can be down. A steepening has a matching flattening, and curvature change can push the belly down instead of up. Also, the steepening here is BS steepener where long rates rise and short rates fall. A bull steepener where short rates fall further than long rates produces same slope change with a different level effect. So slope change and level changes are separate factors and cannot can occur together, right? Please keep that in mind. And where it is used, these three shapes are the shocks applied in period duration reports and the IRR-DB scenario from slide 11. A portfolio hedged only for the red line remains exposed to the green and purple line. Then we go to slide number 13, yield curve for macroeconomic forecasting. Yield curve as macroeconomic indicator. Yield curve contains valuable information about future economic conditions and expectations in financial markets. Economic signal from curve shape. Normal yield curve, market expects steady economic growth and stable inflation. Inverted yield curve often signals an upcoming recession or economic slowdown. Steep yield curve indicates strong expansion expectation and possible rising inflation. Economists and financial researchers use statistical term structure models to analyze macro financial relationship, embedded in yield curve, common yield curve models, Nelson-Siegel model, Stevenson model, Diebold-D dynamic factor model. These models extract latent factors such as level, slope, and curvature to study the interaction between interest rate, inflation expectation, and economic growth, right? So remember that point. The slide moves from the balance sheet to the economy state to the curve shapes carry information about future conditions, three shapes, and their standard readings. Normal yield curve, upward sloping, read steady growth and stable inflation ahead. Inverted yield curve, downward sloping with short rates above long rates. Read as a signal of a coming recession or slowdown. Steep yield curve, upward sloping with a large gap between short and long rate. Read as strong expansion expectation and possible rising inflation. Term structure model, a mathematical description of the whole curve using a small number of arrangements. The slide names three Nielsen-Siegel model fits the curve with three factors interpreted as level, slope, and curvature. Stevenson extension adds a fourth factor to Nielsen-Siegel so the curve can hold second hump. Diebold-D dynamic factor model takes the Nielsen-Siegel factors and models how they changes over time, which allows forecasting. The slide closes by stating that these models extract level, slope, and curvature to study how rates, inflation expectation, and growth interacts. One clarification here is the inversion signal needs three qualification. First, it's a statistical regularity in United States data, not a mechanism, and the lead time has ranged from several months to 2 years. Second, the signal depends on which pair of maturity is used, and the 10-year minus 3 months spread and the 10-year minus 2 year spread have different timings. Third, inversion can also reflect a fall in the term premium rather than expectation of rate cuts, and those two causes carry different information. One clarification here is three models are curve fitting and forecasting tools. They are not arbitrage pre-fitted. Nelson-Siegel forward rates can violate no arbitrage condition. So those models are used for macro description and central bank curve obligation, not for pricing derivative of the fitted curve. Nelson-Siegel family fits the observed curve smoothly with few parameters used for macro analysis curve obligation. You have no arbitrage models such as Hull-White, HGM, which price consistently with no free lunches and used for derivative valuation and hedging. The one difference that matters is one describes the curve, the other pricing instruments of it without allowing arbitrage. Where it is used, the level, slope, and curvature factors here are the same three factors used as war risk drivers on slide number 10. Then we get into next one, which is yield curve in your portfolio construction, which is bond portfolio structures. Bond portfolio managers actively use yield curves to design bond portfolios that match interest rate expectation and risk preferences. Common yield curve portfolio strategies, bullet portfolio investments are concentrated on a single maturity. Useful manager expect limited yield curve change. Barbell portfolio investment split between short-term and long-term maturity. This structure benefits from changes in curve steepens. Lateral portfolio bond maturities are evenly distributed across time, provide stable cash flow and reduces reinvestment risk. Effectiveness of these strategies depend heavily on the expected shape and movement of the yield curve. So slide basically covers three ways to arrange your bond maturities in a portfolio. Bullet portfolio holdings are concentrated on one maturity. The slide states this suits a manager expecting limited curve change. Barbell portfolio holdings split between short maturities and long maturities. We are little in the middle. The slide states this benefit for changing the curve steepness. Lateral portfolio maturities are spread evenly across time. The slide states this gives stable cash flow and reduces reinvestment risk. Reinvestment risk is basically the risk that maturing money must be put back to work at a lower rate than up before. Slide closes by stating that the effectiveness of each structure depends on the expected shape and movement of the curve. On clarification, I'll add here the bullet and barbell comparison is usually made at equal duration. Held at equal duration, the barbell has higher convexity than the bullet. So the cash flows are spread further from the average maturity. Higher convexity means the barbell outperforms on larger parallel moves in other direction and underperform on smaller moves or when the curve is stable because the market charge for that convexity to a lower yield. The slight line about steepness is the second effect. With duration match, the barbell loses when the curve steepens and gains when it flattens because its long leg carries more of the precise sensitivity. Bullet basically cash flow cluster at one maturity, lower convexity, higher yield. Barbell basically cash flows at two ends, higher convexity, lower yield. The one difference that matters at the same duration is choice between them is a trade-off, yield against convexity. Where it is used, these structures are the position whose exposures the key rate duration from slide 12 are built to measure. Then we go into write the yield curve strategy, yield curve trading strategy. The write the yield curve strategy is for the shape of the upward yield curve. Strategy logic: investor purchase longer maturity bonds with shorter yields, with higher yields. Right, as time passes, the bond moves towards shorter maturity. Bond is then priced using lower yields on the curve. This process generates two sources of return: one is the price appreciation and the bond rolls down the curve. Higher rolling yield compared with the long-term bonds. Risk consideration: if the yield curve flattens or invert, the expected price appreciation disappears, the strategy may produce losses, right? So slide curves a strategy that earns from the shape of an upward sloping curve. Write the yield curve, also known as roll down, by a bond at longer maturity where yields are higher, hold it and let time move it to a shorter maturity where yields are lower. The slide three-step logic: buy a longer maturity bond with a higher yield. As time passes, the remaining maturity shorter. The bond is then valued using the lower yield that sits at that shorter point on the curve. Two sources of return follow: price appreciation, which is a lower yield means a higher price, so the bond gains value as it rolls on the curve. This is the roll down return. Higher rolling yield: bonds keep on income exceed with a short dated bond would have paid over the same period. This is the carry. Risk consideration: the curve flattens or invert, the yield and the short maturity is no longer lower. The expected price gain disappear and the strategy can lose money. The strategy can be written as total return is equal to YT, which is nothing but carry, plus your YT minus H, right, into your DT minus H. This is the roll down. Okay, total return is approximately your equal to sub T, which is the carry, Y sub T, which is the carry, plus the quantity Y sub T minus Y sub T minus H times D sub T minus H, which is the roll down. The formula says the return comes from the yield earned plus the price gain from moving to a lower point of the curve. Y sub T is the yield at the lower original maturity. T H is the holding period. Y T minus H. Y sub T minus H is the yield at the shorter maturity reached after holding. D sub T minus H is the modified duration of the bond attached to shorter maturity. It is used to separate the income part of the return from the shape part. On technical clarification, the strategy is not free money. It assumes the curve does not move. If the forward rates are realized, meaning the curve evolves exactly as today's forward imply. So roll down return vanishes and every bond on the same short rate. That strategy pays only when the curve stays more static than forward predicts. It is better against the forward curves and carries the associated risk. Carry basically income earned from the coupon and yield depends on the level of yield. Roll down basically price gain from moving along the curve depends on the slope of the curve. The one difference that matters is carry survives a flat curve. Roll down does not. Where it is used, this is a standard bond portfolio strategy and exposure is a slope exposure measured with steepening stock from slide number 12. Then we go to slide number 16, yield curves and bank treasury operation, role of yield curves in bank treasury of functions. Bank treasury departments rely heavily on yield curves to manage internal pricing, liquidity, and balance sheet risk. Key application in treasury operation: fund transfer pricing, FTP, internal pricing mechanism used to allocate funding cost across business units using market yield curves. Lending rate setting zone: interest rates are often determined by adding credit spread to benchmark yield curve rates. Liquidity valuation: treasury team assess the value and cost of liquidity using discount factor derived from the yield curve. Capital allocations: bank evaluate the profitability of business segments by measuring the risk-adjusted return related to yield curve benchmark. The yield curve therefore acts as the reference backbone of internal pricing and risk management system within your modern banking institution, right? So slide is basically covering four uses of the curve inside the bank treasury. One is FTP, one is lending rate setting, liquidity valuation, one is capital allocation. The technical clarification I can add here is modern FTP has more than one component. The base transfer rate comes from the curve as the slide states, but the bank at a liquidity premium. Also for long-dated illiquid assets, a contingent liquidity charge for undrawn commitments and the cost of the bank own rate spread over the risk-free curve. Charging only the curve rate understates the true funding cost of long assets. Another point is FTP separates rate risk from business performance when a branch writes a 5-year fixed loan. FTP, fund transfer pricing, moves the interest rate exposure to the central treasury book at the 5-year transfer rate. The branch keeps only the credit margin. This is the point of mechanism and is why the curve rate must match the product's maturity. Fund transfer pricing rate is internal, curve-based, no credit component, moves rate risk to treasury. You look at customer lending rate, that is external, curve rate plus credit spread plus margin, compensate for default risk and profit, right? The one difference again that matters here is the transfer rate strips out credit, the customer rate adds it back where it is used. The transferred exposure accumulated in the treasury book, and that book is the one measured by the EVE. economic value of equity calculation, slide number 9. Okay. Then we go to slide number 17, which is summary. While yield curves are indispensable in finance, yield curves play a central role across financial market, risk management, and banking operation. Pricing, define discount rates for future cash flow, enable accurate pricing of bonds, swaps, and trusted derivatives, provide the term structure required for valuation model, risk management, determine duration and convexity of fixed income securities, influence war and stress testing frameworks, capture sensitivity to interest rate shocks, macro and market insights, reflect expectation about economic growth and inflation, help forecast decision and economic turning points, guide bond portfolio and trading strategies, right? So slide group the lesson into 3 headings: pricing, risk management, macro, and market insights. That's what we need to know. Okay, so it's very self-explanatory. You can read it. Okay. Then we have practice problem. Practice problem 1: bond pricing. Pricing a bond using the yield curve. Bond has 2 future cash flows. This and this. Yield curve provides discount factor. Solution is given. Total bond price is calculated. Then we have next one, again, forward rate calculation, computing forward rate from spot rate, given 0 rates are given, compute the 1-year forward rate starting in year 1. Arbitrage formula, no arbitrage formula is given, substitute values, forward rate can be found. Then we have impact of yield curve shape, portfolio duration is given, yield curve shift is given, duration approximation, formula is used, substitute values, interpretation is written, you can understand that. And then we have effect of yield curve steepening, if the yield curve steepens, long-term rates rise, short-term rates fall, which portfolio benefits most, right? Explanation given, Babel portfolio, why, the whole explanation given, you can read that. Then we have bank yield curve risk, interest rate risk for banks, a bank funds long-term loans using short-term deposits. What are the possible risks? What is the solution? Rising short-term rates, how it affects, what's the logic? It's all given here, right? So that's it, guys, that's it. And reach your practice question, you have to go back and do practice question on your own. This is a part of your active learning. Concepts are already explained, formulas are already given, questions are given with your solutions. You have to just go back, read through them, apply your mind, and practice it, right? That is how you understand and learn faster, right? That's the part of your active learning. Overall, if I have to explain how the complete chapter or lesson fits together, the curve gives a 0 rate at every maturity in slide 2 turns those rate into discount factors, slide 3 to 7. Use the discount factor to price your bond, forward swap, and interest rate option with forward rates and discount rates doing separate jobs. Slide 8 to 12 holds the instrument fixed and move the curve instead, producing duration, convexity, economic value, war, and stress test. Slide 13 to 16 read the curve outward using its shape as a macro signal as the basis of portfolio structure and trades and as the reference rate inside the bank treasury. Slide 18 to 22 apply the same two tools in numbers. Discount factor, forward rate, duration, curve shape. 5 common mistakes which you should avoid, right? Discounting every cash flow at one rate, you should avoid that. Each payment has its own 0 rate. Using the yield to maturity for all of them gives a price that can be arbitrage against strict market. Reading a forward rate as a forecast, please don't do it. The forward rate is the break-even rate implied by today's curve, the gap between it and the expected future spot rate is the term premium. Then mixing compounding convention, again, the same to 0 rates give, different values depending on whether the convention is continuous or annual. So keep in mind. Treating duration as a complete risk measure, duration captures parallel shift only and only for small moves. Steepening, flattening at risk need key rate duration, large move needs convexity, keep that in mind. Reversing the barbell result at equal duration, a barbell wins on a flattening and loses on a steepening. Because its long leg carries most of the price sensitivity, so remember that. Okay, that's it, guys. That's it for this lecture. Go back and revise it, and I'll see you in the next lecture. At least do it twice, right? And then you'll be totally fine. Okay, that's it from my side, guys. I'll see you in the next lecture. Okay, thank you.